Today I am doing Ask Sam, and today I am helping all those people missing good old Jason Witten and his morning live. So today I thought I would try and be Jason for just around 15 minutes to help everyone with their, I guess, loss aversion to not hearing from Jason. He's actually doing some pretty cool things at the moment. He's running around doing some coaching. Yeah, the great man is doing some coaching. So if you're missing him, I think he'll be back tomorrow. Morning, Alison. Thank you for tuning in today. I'm stepping into the shoes of the great Jason Witten and certainly trying to run a play for people today. So certainly my skill set, if you like, is more yabbering along rather than using the pen. But as they say, the pen is mightier than anything. So wanted to sort of talk about time in the market today and talk about something which happens to a lot of investors, which I refer to as the flat line. So as you're probably across it, when we look at the marketplace, there's certain properties that are skyrocketing in value, and then there's other properties which are softly going up in value, and you get these kind of value extremes in the marketplace. And for many property investors, because of price points that quite often property investors buy within, they're sort of buying in that sort of get-going marketplace. Quite often what you see with more expensive properties, people have got to trade in to push the values up. So you often see that with property investment. So quite often with property investment, because a lot of people are buying for $300,000, $400,000, $500,000, $600,000, that marketplace is kind of lumbered in almost with the first homeowner market a lot of the time. And it's like people coming to that marketplace really are using cash or equity, whereas opposed to sort of that $1 million plus marketplace, generally people getting in there have a trade in. So they're flipping something, they're selling one property, they're moving, they're upgrading. So you generally see this kind of correlation of sort of, more growth in higher price points. And so what happens to a lot of property investors, now this is me being Jason, we have a little starting point, right? And if you like, we're going to go up this ladder. And for many property investors, the end point is really the asset doubling, if you like, in value. So we want to start, we want the asset to double, and we need about 15 years to go on this journey. What happens to a lot of people is they get to this point, which is what I call the flat line. Basically, yellow is not a very good color, is it? Let's go with blue. So basically what happens is their asset, if you like, people start to question whether what is going on with the asset. I've only made $100,000, or my asset, is stagnated, but the rest of the market is flying along. And quite often you compare what you've bought to many people who perhaps are part of that upgraded marketplace. So what happens is a lot of people then end up in this place where they get sort of spat out of the real estate market. They get to a flat line period, and really the asset, if you like, and the person start to make a decision. Should they keep going and wait it out, or should they take a loss or just move the asset for, a can of Coke, so to speak? So this happens to a lot of property investors. They get to this sort of period where I guess you would call it like a flat line. And one way to kind of consider the flat line, if you like, let's call this the flat line, is we need to know whether our asset is going to keep moving or indeed it's actually going to get stuck. The best way to understand that is when we think about real estate as an investment vehicle, generally we're buying an investment that someone is going to see value into the future. We're exchanging money today for more money later on. And so quite often, if we're going to see our asset continue to bubble along, it's the sophistication of the market basically identifying that what we have is valuable. And quite often in our first 5 years of owning real estate, the market doesn't necessarily see what we own as sophisticated. We've bought something relatively inexpensive in the market because we're using the rental return to hold the asset. And after a period of time, we start to go, well, is this really actually working? And what I often see with investors is they've done the hard work. You've got the asset. Now you've just got to keep going. And a lot of property investors start to question whether their asset is actually sophisticated enough to keep going. Now, this is a really good question because there are some indicators which will tell you whether you've bought an asset which is sophisticated enough to keep going. Certainly, I see the flatline effect occur, and some properties actually are not sophisticated enough to keep going, and they tend to start to go down in value. So you hold them for a period of time, they don't resonate with the market, and then really the only place for them to go is down. So how can we tell the difference with what we're holding? And for me, I've been through this emotionally. I've been through this also with, assets I own. I've had assets which I've questioned their sophistication. Lo and behold, 7 more years holding them, they've gone on to make $1 million. So how do we know where we're at when it comes to, is our asset going to keep being appealing to the market, or is it going to start to decline in appeal? So for me, what I'm always looking for is investment in the area, and also stock coming to the area. Now, what you'll often find with your assets is because you bought them at a period of time, say down here, and now you're re-examining them, let's say 5 years later or 7 years later. Actually, what happens is over a period of time, there is sophistication improves for people. So people's viewpoints change. All of a sudden, there's the iPhone 14 and the iPhone 15. So it's an interesting place to be because here you're buying something that you're hoping someone will actually like, and the appeal of the asset will continue to improve. That's the point of doing a long-term strategy. You're buying something that gradually actually improves, and at some point, the sophisticated marketplace will come in and really pay more for it. So what you kind of see is almost like the tailwind of capital growth can often be far greater than the initial hit of capital growth. So by way of example, the property, for example, that I recently made $1 million out of, I bought it in 2011. By 2013, it had done zero. By 2015, it was probably up about $200,000. By that point, I was like, well, happy, but I was also questioning, is that it? Is that the end? By 2021, the property had risen another $800,000. That $800,000, around $700,000 of that was all in 1 year. Okay. So in real estate, we often call that mean reversion. But what had happened is I bought an unsophisticated property in 2011. And by 2021, the market finally paid me for what it was. All of a sudden, it made sense to the marketplace. So what can happen is we can buy assets which stagnate or flatline. And then if we don't know there is stock coming to that market that is improving the value of that area, then we can often not, I guess, comprehend what is about to happen in the future. So sometimes new stock coming into the market is a leading indicator for future gains. So let's say we own a property here for 500, but we can see the new stock coming to market over the horizon is $650,000. Now, we only bought 5 years ago at this point. So our stock is very comparable to the new stock coming through the system. Our value today may only be $550. So we're questioning the flat line effect. We're going, well, we've only made $50,000. Is that it? But we can see the level of sophistication is continuing to improve. Where this starts to struggle is when you get a marketplace where there is no improvement on price, where there is no stock coming through the system, pushing the envelope of value up and up and up. And quite often I've certainly had the flat line effect where, particularly in some regional marketplaces, when there is no future investment in those marketplaces, there is no sophistication coming into the marketplace, and really your asset starts to decline in value. And I've certainly had that. So obviously, when we think about where we are in the market today, one could say we're at a boom period. And what has happened to a lot of property investors is they've had an asset which has basically been on either side of the flat line effect. Some people might have bought an asset for $400,000, 5 years ago. And today, after the boom, it's now only still worth $400,000. What happened during that 5 years? Their property might have gone down to $300,000. The boom has brought them back to where they are today. Other people have assets at $400,000 today, which are now, $500,000. So what next? What next? Now we are finally at a point where we are going from boom to actually boom recovery, which is what we want as a property investor. So the best way to understand the boom was we had 5 years of no growth, and now we had really one big year of 5 years worth of growth. So what can happen in real estate is after a boom, you can have a slide, then a trough, then you can have a bottom, then you can have a recovery. Then you get sort of like a hot market, and then you have a boom again. A little bit different this time as to where we're at in the property marketplace. We're actually at a period where we've got a boom, but we're actually now recovering from the burst of the boom. And we're now going into a place where we're more going to get growth of sort of 5% per annum on assets, 6%, which is what we actually want in the real estate marketplace. We want this sort of good, moderate level of capital growth rather than periods of total stagnation of no growth and then one big year of capital growth. And that's called mean reversion. So interesting where we're at the moment in the marketplace. A lot of property investors probably are here at the moment in this kind of, I might draw this again. This is why Jason's really good at this stuff. I'm not very good at actually using these bloody. So here we are. And the ultimate is the double. Our starting point and the loss. We are probably all at this point at the moment when it comes to how we view our assets. We're in this kind of middle bit, which is the hardest bit to be. And again, I think when you look or analyze your assets, you potentially are about to see even more capital growth as the sophistication works its way down from the top to this kind of middle section of where your asset is today. Because when you started out buying assets, you quite often as a property investor spending 400, 500, and the trade up market is spending 1 million, 2 million, that kind of money. So they're people who trade up, sell something here they've made some money out of and invest it here. And because they're investing it here, there's just more money pours into this kind of funnel, if you like. Because most of us invest here, and the reason we do that is because of affordability, but also the rental return. We don't want to here, you might buy $1 million asset or a $2 million asset and only get $700 a week. Here, you might buy a $500,000 property, but get, $500 a week. It's kind of the logic of a yield balancing act. So we need all these people eventually to come and pull us up. They're only going to pull us up if we have sophisticated assets which have been parked through a period of time. And this is very much what happened to me in a recent property. It was unsophisticated. It was cheap when I bought it. By 2021, it was considered sophisticated by the market. And all of a sudden, they were seeing it as a trade up. So think of it that way. You are buying a non-trade up here and you get stuck quite often here, but you need someone to trade and want it later. And quite often that is time in the marketplace. So I don't know how I went doing a Jason Witten, scribbling around, but hey, thanks for listening to me today. And hopefully there were some insights into where you are today. Just one good way to analyze real estate. I might leave you with this so you can really start to work out where your portfolio is. Okay. So So when it comes to valuation, the good way to understand whether you're going past the flat line, remember there's a flat line, you can go below it or you can go above it in sophistication. First method of valuation is direct comp. Now, direct comp, a direct comparable, is quite often what you will use. It's known as like for like. So when you do a desktop valuation, for example, they will do this. They will say, well, you've got a 4-bedroom property. This is what the other 4-bedroom properties in the neighborhood sell for. So that is quite often how we perceive where we are today in the marketplace. However, there is another method of valuation known as summation. And summation is basically the replacement value. Now, if you were to go and look at your portfolio, you will notice that the replacement costs for your asset, let's say you bought a property for 400,000, direct comps, I don't know, let's just call it 500,000. You may actually see the replacement cost for your asset is actually $600,000. And as long as there's assets coming into the market around that replacement cost, even though you are sitting here from a direct comparable point of view, you're actually looking over the horizon. And when you look over the horizon and can't see replacement costs actually improving, you've probably got an asset which maybe we should all have a closer look at and potentially offload. And I've certainly got one. I've got one which basically, using the same logic, $400,000, the replacement cost is $350,000. The valuation here is $350,000. The direct and summation. Excuse my spelling. So you can see when I look at this asset that I own, I am now stuck. I've got no sophistication of the demand coming through. Replacement value for my asset is not improving, and the direct comparables obviously are the direct comparables. So in this case, I am going back to the flat line, and I can see for that asset, really it is not in a good place. It's not where it should be, and I now need to make a business decision. Do I sell the asset or hold on? And really, when I start to see, for example, this, I can tell that it's going to be years before I get anywhere with that asset. So it is flatlining and it is going to stagnate. And for me, I'm a kind of property investor which doesn't mind making a loss to create more opportunity, but not everyone can mentally handle that kind of stuff. So, the best way to do that is just stick out at more time. But you can see the polar opposite for other properties I own is the flatline effect. Today, the asset, let me choose, one asset today is $600,000 in my head. New assets coming into the market are $700,000. And if I was to do direct comparable, it's probably 650. If I was to use summation, it's 700. So I know I'm going in the right direction. Okay. All right. That's it for Jason Witten today. I hope you understood me, because to be honest, I don't use the pen and I was a bit nervous. So how did I go? Was I okay? All right. I might leave it at that before I do something even more stupid. Thanks for listening, guys. You have a great day.